Hello and welcome back to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today. During the first segment, we talked a little bit about when you're looking at the performance of your investments or charts on TV or the newspaper or on the internet, make sure you know if you're looking at total return charts, price only, and make sure you know which currency they're denominated in. There can be some significant differences between all of those. If you missed the first segment, head on over to our website, www.dlblain.com, and there we'll post archives of the show so that you can get caught up. So in this segment, I want to start our discussion a little bit about the concept of market gurus. One of the reasons I do this TV and radio show is to try to get some factual information out to people that is maybe a little bit different from the constant noise that you hear in the newspaper and the TV and media. Last summer, the New York Times actually did a study about why the media, and this would be the newspapers, TV, even internet sites, why they constantly provide a platform to these financial gurus with often extreme and simplistic views. You know, the world is coming to an end, or the Dow 30,000, these very extreme type views. And the answer is simple, that the middle of the road consensus thinking is boring, that it's much more provocative and interesting to have a guest with these unconventional type views. And it's led to this whole sort of cottage industry of these media hounds and people that are constantly predicting, one thing or another, and that's what attracts the viewers, and that's why people, these media outlets, continue to hire them. One of the interesting things about these media people is that a lot of times, not always, but a lot of times that they don't manage meaningful amounts of money, or they don't manage money at all for clients. They have no vested outcome or they have no vested stake in the outcome of their predictions. There's just a little background, and I wanted to go back in history and talk a little bit about some of the four worst gurus that have existed. The first one will go back back to the 1920s. A guy by the name of Irving Fisher from Yale. He was a household name in America, by far the best-known economist at the time, and his pronouncements regularly made front-page headlines. 3 days before the crash of 1929, he famously announced that, and I quote, "Stock prices have reached what appears to be a permanently high plateau." That was 3 days before the crash. And for months after it, he maintained that a recovery was imminent. Let's fast forward a little bit. I'm sure there were people in the interim. These are the ones that I researched. In 1980 and 81, there was a man named Joe Granville. And just Google these people, and it's fascinating reading to read about him. And he had investment seminars, and he drew packed audiences from all over. And his predictions would actually cause the market to move in the next day. He even predicted that he would win the Nobel Prize in economics. And one time he even created a stage with a swimming pool that he put concrete in, so it looked like he was walking on water as he came out on the stage. I mean, this guy was just crazy. And so he had this huge following of people. But when you look at his performance, Hulbert Financial Digest tracks the performance of market gurus and newsletters and things like that. And from 1980 to 2005, he was dead last among American newsletters, with investors who followed his advice losing 95% of their capital. That's quite a disaster. There was another guy, Robert Prechter of the Elliott Wave theorist, in 1987. He told his clients to sell in advance of Black Monday. If you recall, 1987 Black Monday, the stock market dropped about 25% in one day. And so he has been living on that one prediction ever since, even though he told his readers to stay on the sidelines throughout the whole bull market of the 1990s. And most recently, another famous blow-up in 2000, Merrill Lynch tech guru Henry Blodgett predicted that tech valuations would continue to climb and backed up his words by putting his personal net worth on the line, most of which quickly evaporated. And so I just wanted to kind of set that background about some of the famous predictions of people that didn't quite work out, as well as why the media continues to put these folks on TV. It's simply because a lot of the basics of making money are somewhat boring. They don't change on a daily basis. It's a very methodical process. In fact, if I could sum up all the advice in the world of one simple thing, is simply spend less than you make and save the difference. If people would follow that simple piece of advice, most people would be much better off financially. But anyway, we wanted to just kind of highlight that. There are some websites out there that you can look up the predictions of these gurus. You know, Jim Cramer is one. And you see that the vast majority of them, 90–95% of them do not beat the market over time, which is presumably their goal. That there's even a slightly negative correlation between their predictions and what actually occurs. So we want people to get good information. Make sure you understand who you're listening to. Make sure you understand the biases that they may or may not have. And someone that's making bold, extreme predictions on either side of the markets is probably out there just to get the attention, and a lot of these folks don't manage meaningful amounts of money for their clients. Well, when we come back, we're coming up on our second break. When we come back, we're going to talk a little bit continue talking about this a little bit further in detail. So for All Things Money, I'm your host, David Blain. We'll be right back after a few short messages.